So for the first panel of today, for the second part of content, we have the instrument that's going to be bull market resistant, bear market resistant, the stablecoin. So we're going to, and we have a great panel to chat about stablecoin, but not just stablecoins, most importantly yield, and how institutions can think about it. And for that, we'll just do a quick round of intro, starting to my left.
Yeah, thank you, Sacha. I'm Brendan MacNeil, head of DeFi at Qapture Investments. Qapture Investments is the Fred Pai family office based in Bermuda. He's the founder of 3iQ. We run a liquid digital asset fund with a 7-year track record, which is now a multi-strategy, as I've been brought on recently to bring my stablecoin yield strategy into the product. That has a 3-year track record, really used for that downside management. When we rotate out of liquid into stables, we still want to get that good yield. Last year, the strategy was 18%. So there is great yields in stablecoins, believe it or not. And it is bull or bear market resistant. So yeah, thank you. Passing it on.
Hi, my name's Elaine. I am on the strategy and corp dev team at Gemini, which is a crypto exchange and qualified custodian.
Hey everybody, I'm Jared Hedglin. I've been at RE7 for a year, but I am on the BD and partnerships team. At RE7, we have a DeFi market neutral yield fund that's been running for 4+ years. We run additional yield funds like BTC and ETH, and then we're one of the largest curators in the space when we're launching Morpho or Euler Vault. So yeah, nice to meet you all.
Hi, I'm Stuti. I'm a partner at Triton Capital. Our team was formerly known as Kraken Ventures. Our investment thesis is that blockchain is better infrastructure for financial services. So a lot of what the TIE does is relevant to us. We've invested in some companies like Anchorage, Athena, Morpho, companies that might be here today that you know of at the early stage, and that's our focus.
So to get us started, I think it's important to look at, okay, what is stablecoin yield? Where does it come from? And what are the biggest misconceptions around that?
Happy to start it off. I'd say misconceptions are that all DeFi yield is the same and that there's a risk-free rate in DeFi. And so the closest thing you might get to that is using a centralized exchange or a custodian and getting a T-bill pass-through. But institutional investors often, when they're approaching the market and asking us questions on if they wanted to deploy themselves versus deploying through us, why would they do that? And when you look at a Morpho vault that has 3% or a Morpho vault that has 5% or a Morpho vault that has 7%, you need to deeply understand where those yields are coming from, what collateral assets are underlying, and smart contract risk, bridge risk, composability risk. And so that's where I'd started off. A lot of DeFi yield looks all the same at a high level because it's a liquid pool, but that has way deeper implications.
So yeah, I have a similar answer, so I'll just follow. Yeah, I think when people see stable coins, they see a bunch of $1 and that all does look the same. And $1 sounds pretty risk-free. So we do have to kind of negate this assumption that we're getting risk-free yield. What should be taken into account is that the yield that you're getting, you're paying for it because you're taking risk on whatever the liquidity profile is, your smart contract exposure, the credit worthiness of who you're taking that yield from. So you also don't want to leave that yield on the table because there is a risk that you're being paid out for. I think another thing that's a misconception, and this is thanks to the Genius Act, is that because of the Genius Act, there are no longer yielding stablecoins. So there are, in some ways, like you have the payment stablecoins now, but there are plenty of other workarounds through which yield is still being distributed. That is, for example, through airdrops or staking, through vaults, or through rewards in exchanges and such. So you also don't want to leave that on the table as well.
I'll jump in quickly on that point. You mentioned the Genius Act. I was thinking on the stablecoin yield point, we heard from Coinbase after the Genius Act was passed that they were getting pushback about offering yield on stablecoins. And they're saying, well, no, it's not like treasury bill yield, it's rewards. It's like loyalty rewards. Hold a stablecoin, get a reward. And that's kind of been the framing of yield since that point. But I want to point out from our point of view, from the active management standpoint, I mean, yield comes really for us from organic trading activity on chain, like acting as a market maker for stablecoins between USDC, USDT, other stables, and generating yield through legitimate trading strategies. And I think that might be where it goes longer term, is like, what's the sustainable yield strategy? It's probably not a loyalty program.
Yeah, I mean, I think kind of to wrap up kind of what everyone has said, which I definitely agree with, is, you know, at the end of the day, right, like not all stables are the same, right? Just because they're called stable coins doesn't mean that they are, like you said, like risk-free, right? So you really need to understand, like, you know, even though they might look the same, their risk profiles might actually be different, like where the yield is coming from, right? Is it actively managed, or is it from liquidity provision, or are you lending over collateralized, or is it just from like the actual assets or the collateral that's backing the stable? Like, you know, I think there are a lot of misconceptions just that like all stable coins are like generically the same asset class and, you know, have the same risk profile. And I think, you know, just this discussion alone shows you that's not the case.
Yeah, and also before, right, like all the DeFi traders from DeFi Summer will remember those like USDC, USDT pools with like 50% APY or whatever. So to your point, what you're saying is here what you're bearing is some kind of like market making risk, liquidity provisioning risk. And how do you, before you even chase yield, with Genius, do you have to think now about principal risk, about like stablecoin DPEGs or like smart contract? How do you think also about the principal aspect when you try to chasing higher rewards?
Well, as a manager, I think the first priority, of course, is not losing money. And so as a stablecoin yield strategy manager, that comes in at the very beginning by running a risk model, which essentially assesses what is the probability of this stablecoin depegging and going to zero, or not even zero, going to 0.95 is still a big event. And how that influences with the Genius Act, I mean, quickly to wrap on that note, I look at it more so from the perspective of if my risk model is working and assessing good quality stablecoins that aren't going to depeg, that are going to last and are low risk, those probably are also the Genius compliant ones because they're the most legitimate. You know, USDC comes to mind. They're fully audited, fully collateralized by high quality assets, et cetera.
Yeah, I would just say, you know, quickly, like post-Genius, right? You're opening up this new channel of like payment stablecoins. I think we're already seeing, you know, a lot of like research come out about how, you know, users and, you know, people around the world are really excited about payment stablecoins. And so definitely from an allocator's perspective, it's something that you should be very concerned about, or at least monitor, right? Like your principal. But even as like an average consumer, if you're using this as a payment token, then, you know, actually it does need to hold its peg, and, you know, you need to like ensure that from a certain degree.
Yeah, I mean, I think from a payments perspective, absolutely. From the yield chasing perspective or the yield optimization perspective, we, you know, utilize these Genius Act compliant stablecoins, and it's huge progress that we have clarity now finally. But I would say from a manager's perspective, it just makes it that much easier to give a great risk, you know, rated score for this particular asset to justify using it more. Now, then we can use it in the system, but we need to compose it with other deep strategies and deeply liquid or somewhat illiquid opportunities, but that's all then, you know, built into our, and I know we have similar risk rating systems, but it's like a 40-point risk rating system with audits and smart contracts and team history, and all of that input goes into an objective output similar to, you know, the S&P team who are on the panel. It's AAA to D. We rate the risk and we say this is how much concentration we can have. And so, you know, the standard Genius compliant stablecoins, those are very highly rated assets. But we also have to rate every single smart contract, Oracle, liquidity, you know, composability risk in addition to those as they go down the sort of DeFi rabbit hole.
Yeah, I think, so for us, we're a VC fund. So we're not just, investing, doing like yield farming, et cetera, just for the sake of it. But we do evaluate risk of new stablecoins because that becomes a part of our diligence process. And like I can share like a rough framework that we use, like kind of a first pass. So the first thing that I look at are what are qualities of the stablecoin that I have proprietary access to understanding because I'm speaking to the team. So that is looking for edge or risk around the team itself, what their legislative strategy is, or do they have connections like in legislation? What kind of cost structure are they pursuing? And what is their distribution strategy and their distribution partnerships? So that's kind of the first area of like risk and also upside that I'm evaluating. The second is thinking about what they're building from the perspective of a very smart consumer or a smart allocator. And on that note, some of the topics I would look at is it composable? Because there's actually plenty of stablecoins that are coming out from TradFi institutions right now that are not composable. And I'm not sure that there's that much value to just holding a dollar that you can't leverage that also has custody risk and counterparty risk. But yeah.
I mean, could that create potentially more if you think in a transient world in which you have all those issuers issuing stablecoins on Tempo or whatever solution, right? And they're all trying to offer some kind of yield to trap people in their ecosystems and use them as payment rails on their ecosystem. And then you have all those like bridges between them. Is that an opportunity for like further yield with this lack of market efficiency?
Yeah, I mean, I think
Yes.
it's up to the issuers to decide, whether they want to like free their stablecoins from the shackles of being non-composable. I don't think anyone is asking for non-composable stablecoins. But yeah, this like composability part is very, very important. Then there's incentive engineering. So a lot of this is, limited by this Genius Act, but as we talked about it, there's ways around it too. So is there kind of natural yield or incentives that are coming from the issuer's balance sheet? Then another big thing is peg stability. So that's a big aspect of kind of understanding like the risk of a stablecoin that I'm investing in. And then there's just like standard risk, like, okay, what is the smart contract risk? Let's look at their audits. What's the operational risk? Like, how do they manage like their treasury, things like that. And then finally, I think this is one of the most important is redemption risk. So what sorts of requirements are there around redemption? Like if I was somebody who was allocating, I would try to stress test their model by saying, if I put this size in or this size, each time increasing it, and there's a huge drawdown event in the market, how much of my capital would I get back? And where in that like capital stack would I be once that's happening, based off of however their governance works? But yeah, that's how I think about evaluating the risk of a stablecoin and suggest that others do too.
Yeah, I think kind of your point on the redemption risk is super important, right? Like, I think in order to understand that, you have to understand, what are the sources of yield, right? Is it managed or is it just based on like what the asset is backed by? And exactly to your point, like from an operational perspective, whether you are an allocator or an institution looking to provide this service or this product to your users, or like a random B2B2C like company, like you need to understand, right? Like where and like what redemption will look like in stress or edge cases.
Yeah, let's use that opportunity to double click on risk. And so I'll let you say what you wanted to say. And then if you could follow up on with like, what's the first risk you actually try to like really think thoroughly through before you even start looking at a stablecoin?
Yeah, and so one clarification point that I think is really important that we as an industry are starting to catch on to, but we need to make sure we're defining stablecoins versus yield-bearing stablecoins, which I'm lately more calling yield-bearing tokens, or a package of a multi-strat in a tokenized structure, right? So just wanted to make sure we're outlining that and exactly how we're defining and talking about different yields for stables or what yields you can get through yield-bearing tokens. But going into risk, I mean, again, we touched on Genius. We understand that there's a subset of collateral tokens that now are fully backed and fully, sort of verified by the U.S. government. But once you start getting further down the curve, it's what's backing it and what is the smart contract set? How has this been audited? Is this team, legitimate? Is this run by a DAO? Are there potential, let's say, attack vectors for manipulating the governance of this token? And is that risky to the stablecoin and the underlying value of the coin at all? So I pull this back to like really understanding smart contract risk and what inputs go into that is at its core. But then like things like liquidation mechanisms and liquidity and availability and composability are all like fast follows from my perspective.
But so if you think about liquidation risk, right? Like there could be a lot of things happening, and if you think about stablecoin issuance, there are two sides. There's the stablecoin issuance, and the stablecoin issuer will oftentimes charge issuance and redemption fees, right? For the sort of like authorized participants that are on the issuance side, and then you have all those trading markets where that's where you can get also a lot of yield, providing liquidity for those markets. And if you look at what happened with Circle and USDC with the crash, was banks were closed, so you could not do redemptions, but at the same time you had those liquid markets that were live, and people were trying to price in the risk that banks would default in the liquid markets, right? So did you live through that? What's your thinking about like this type of risk of like underlying banks holding like sound dollars behind that?
I'll take a stab at that one. It's juicy. Lived through it, yes. We have a risk management system for our strategy that clearly defines in the event of a DPEG, the early alert system, the certain thresholds in which actions are taken or not taken, etc. So we manage our way through that within our risk limits. So that was something to be proud of. But so disclaimer first. But that ultimately rolls up into the collateral question, in my opinion. So your earlier question being like, what's the first thing you look at when assessing stablecoin yield? It has to be collateral, because without collateral, it could be everything else could shoot the lights out. But if the collateral quality is low, or if it's illiquid, or if it's under collateralized, you're basically asking to lose money. And the USDC case almost is a TradFi example of the collateral was illiquid at that point. If this had been an on-chain issued stablecoin backed by over-collateralized BTC, let's say, there wouldn't have been that outage, or should not have been that outage, or that 3-day lag that we had. So, I don't know, maybe that's a jab at TradFi that, they're causing a bit of collateral risk.
I totally agree and would add, like, on the USDC DPEG, we made money because you ask about like the fundamental risks of the dollar or TradFi or banks going under, and we knew they weren't. This was sort of Operation Choke Point 2.0 or whatever it was, and they were attacking settlement rails, and we felt that USDC was strong collateral, and we could enter it at a depegged price and gain yield from that in a risk-adjusted way. And so if the underlying mechanics, if the dollar is being devalued and we're about to see hyperinflation, that's a very different question on risk than will USDC maintain its peg to the dollar in that situation based off of the underlying mechanisms. Again, we're going to see, I think, some really interesting stables come out that are collateralized by different assets and pegged to different assets. And we're having a ton of conversations around FX stablecoins and what implications that has on a global scale and hedging and DeFi and composability. But again, risk at its core is sort of what's backing it and what the source of truth is.
Yeah. And go ahead.
No. So I still think a lot of these questions, the answer always starts with redemption, right? How quickly can I get my principal redeemed to me? But one way to also approach it is, where's my money right now? So if I am running a stablecoin and I take people's money and they ask, where's my money right now? It might be with me. But then I might go put it in SVB, right? And I'm like, okay, now it's with SVB. But now it's with them. What have they done with it? Maybe they lent some of it out to get something on the liability side of their balance sheet. So now that's where the money is. So I think if you continue to ask, like, where's my money now, you'll eventually find out where your money is, and you can kind of price that risk.
So we touched a bit on yield, we touched a bit on risk. Now, if we bring the two together, how do you think about risk-adjusted yield? Or, right, is that what you look at when you look at these opportunities?
Yeah, that's the only way to deploy from our perspective. We have this risk rating system to quantify and give an objective number on all of these risks that are inputs into the system. That dictates how much concentration we can have in any given protocol or asset or yielding asset. So the risk adjustment based off of all of these underlying pieces is paramount, because if your alerting system goes offline at 2 in the morning and there's a depeg, you could lose all of your yield for the year in one position, right? And so the way you approach it needs to be systematic and modeled out and back tested. And again, searching for yield is something that needs to be done on an institutional level. If you're DeFi yield farming and just like throwing money around, you can go for it, but it's a high risk, high reward game.
Yeah, Jared, to your point, I would say the same thing, and I would say yes, but our stablecoin yield strategy is intentionally, risk averse. So of course we're looking at what's the risk adjusted yield, but there's a cutoff, and past that cutoff, there's a lot of stablecoins that we do not touch because they have flaky collaterals, or they don't really share their collateral, or it's had a history of volatility, et cetera. And so we could go and try our hand and try to be sophisticated managers and expect to lose 2%, but we're going to make 4%. But that's really not the game that we try to play at Qapture with our stablecoin yield strategy. And we say, what is the safe haven? And that's the name of the strategy, Qapture Haven. Stablecoin yield that we can get, and then leave the rest for the degens.
Yeah, I would say, we're the same too. I think to date, Gemini has been pretty conservative with the type of yield opportunities or reward opportunities that we provide to our users. I think part of it is because we take kind of like an institutional grade mindset, even if we serve, for our retail customers, right? It's something that we just want to be as confident as possible in. That's definitely something that I think about when I talk to, potential issuers or partners who are looking to kind of provide those strategies or services to the Gemini user. But yeah, I think definitely, I think the point here is you need to understand the risk. You need to understand like where the money's sitting at all points, and then just try and price that in.
And how active are people in chasing yield or looking for better opportunities, right? What's fascinating in crypto is a lot of that can be traced on ledgers for now, and that's not something you get in traditional finance, where you look at mutual funds, right, and opportunities with lower fees or here and there. And there's actually a study by Jiajing Gang Liu and Antoine Chouard from MIT looking at this on Cardano, of people, how active people are, how in moving when there are validators that offer lower fees, and how validators that actually know that their delegators are not very active actually use that to price in higher fees. And conversely, when they lose delegators, they tend to lower fees. So how does that work in the stablecoin world? Like, and what happens next? What gets arbitrage first? How do you think about that allocation problem?
Are you wondering like how much capital is actively managed in stablecoin yield, or like who are the managers?
Yeah, how actively managed is it? What are the sort of like quote unquote intermediaries, right? And what is their pricing power in terms of fees?
Yeah, so I think there's a couple ways to approach the question, and it's really the investor and the user. And so I would say for investors in our fund, they're quite sticky, right? We've been running for 4 years, proven track record, have lost like 20 bips a year when average default stable rate is like 5 to 7%. So from the institutional perspective, that could be sticky. From the retail perspective, they might say, I'm starting on an exchange. I'm using their earn product. That's giving me 3 to 5%. that's competitive enough. But then they learn about an upshift actively managed strategy or a Midas actively managed strategy. And they might not fully understand the risks involved, but they see that's a 15% yield. And they don't necessarily know that it's half incentives and half looped in Fartcoin or whatever that might look like, but they see the 15% yield and they start to move. And so I think we do see a bit of chasing. I do say the uneducated investors, unfortunately, are chasing a little bit more, but they have a higher risk profile and are looking to make more faster. So it somewhat correlates to I think the education of the investor and how much risk they're willing to take, because you can make a lot of money going into very risky stuff if you're fast enough, if you have the alert set it up, but that's not the game we like to play.
I think chasing yield is ultimately inevitable, right? Like, why wouldn't you? And so then I think the question then becomes like, assuming that everyone either will actively chase or has a desire to chase at some point, how do you actually mitigate that or manage that in a way that's responsible, right? So for a platform like Gemini, it really is understanding and doing due diligence around like the products or the opportunities that we provide to users. Again, I think that goes back to like, what are the platform's internal risk monitoring systems, or how are you actively managing that and making sure that it's something that you can, with confidence, educate your customers on. And I think ultimately that's what will give institutions an edge, because to like your second point of the question, which is like what's going to compress first, like anything unsustainable, whether it's like token incentives or random looping, like that's going to compress first, right? And so when it comes back to, okay, like we have like a risk-free rate, what additional value are you providing to your investors, your consumers, your users? It's the ability that they can like trust in your platform and understand the redemption risk and know that like when they want to pull their money out, it's going to be there, or they're going to like understand like what those steps are. So ultimately, I think it really is just, it's going to happen. You have to just mitigate around that and provide an ecosystem or an environment where it's safe to do so.
I think in 2026, you're no longer chasing yield, but rather you are harvesting volatility. So if you see an opportunity which is like 500 bips above the treasury rate, the question that you start trying to ask yourself is like whose liquidation or whose transaction fee am I going to be paid off of?
I'll take a stab at that too. To answer the question succinctly, like there's billions in dollars chasing stablecoin yield right now, like probably 3 to 5. During the bull market, it was over 10, like really with like Athena looping strategies. And that's come down a lot because capital's been returned or gone elsewhere. A lot of that capital, let's say it's 3 billion, is looped. So maybe it's actually 800 million chasing yield in stablecoins. And it kind of moves like, I guess, a dog's tail like this, right? So when there's new yield opportunities, which happens every single day, or something changes and an opportunity goes to 15%, there's only like 50 million that moves right away within the first hour. And then within the first day, there's 100 million or a few hundred million. And the rest, which is probably retail, is moving to these new opportunities, Pendle, new chains, a day or a week later. And so what I think that causes is that tail is sweeping across DeFi yields, whether it's from looping, liquidity provision, yield farming, all yield sources, and basically arbitraging them down to the same number. So, okay, looping's at 15 today. Everybody moves over there and it goes to 10. LP's at 15. Everybody moves, it goes to 10. And long term, I think this favors sophisticated managers, which is what Qapture is trying to be, that have the strategies to stay ahead of these yield movements or the trading movements to continuously generate 15 and not 10.
So I have a framework. It's more like one around designing like DeFi protocols or stablecoins that are yielding. And it's essentially a trilemma where on one side you have yield, another you have risk, and then you have collateral scalability. So I think that there are plenty of opportunities where if you're early to it, as you're saying, you can have high yield, you can have managed risk, and you can even like you get the deal, but the thing is, it's going to be usually the collateral base is going to be very small that can support that. So if you're first to it, you're good. When people come later, they won't have access to that. Then you have a different type of model where you have very high collateral scalability, say T-bills. You have very good risk management, say USDC. But then you go up to yield, and they can't really do too much for you on the yield side because that's just the nature of the collateral that they've chosen. And then you have other opportunities, in the DeFi space that fall somewhere in between. But usually, it's a choose to type of thing.
Great. So we're heading on time, but it's time for drinks, I guess. Speaking of liquidity, so we'll leave it there. We'll go through the drinks. Thank you so much for staying until the very last minute.